Hello, everyone. Today on the final bar, we're going to wrap the week as we do every Friday. We'll look Friday close to Friday close. How is the long-term trend? How the long-term trends evolved over the last 5 trading sessions? Today, the S&P really finishing in a position of strength, strengthening into the close, not up a ton, but up around 34.65. So overall, we're continuing to establish this range, and we'll talk about what that means for the long-term direction. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the lenses of technical analysis, behavioral finance, investor sentiment, behavior, psychology, whatever else we can bring to bear to make sense of these markets together. It's been an interesting week with plenty of movement, plenty of volatility. At the same time, probably a less volatile stretch, but with greater uncertainty. I feel like there's so many potential headwinds and tailwinds out there. When I think about my conversations with guests this week, it really hit on some of the key things facing. And for me, it started with Monday's special on the presidential cycle. And I feel like every day I just kept coming back to that discussion with those guys and thinking about what the calendar usually tells you, what the seasonal trend tells you between now and year end, and just all the different things that could push or pull on asset prices over that stretch. We're really talking about the S&P settling into a trading range, sort of that 3,200 to 3,600 range, and I think there is a potential that we can remain in that range a lot longer than many would expect. We'll see what the trends will tell us as we look at the charts here. As I mentioned, we had great guests on the show this week. Mark Young yesterday talking about sentiment was a really good conversation. Next week, we have Sam Stovall from CFRA Research joining us on Tuesday. Sam's a macro strategist, so always a pleasure to talk to someone like that and then think about how that relates to the charts that we're reviewing together. On Wednesday, Jeff Greenblatt from Lucas Wave International, and then on Thursday, Dana Lyons from J. Lyons Fund Management. And I've spent much of my career working with money managers, institutional money managers, and talking to someone like Dana about how he's actually positioning himself given the scenarios that we're talking about, potential scenarios. It's always really, really valuable. So some great guests coming up on the show next week. On top of that, Monday's show is always a really good one as we hit the markets from 3 different directions and hit on all the key themes that the charts can surface for us. Let's get to our Wrap the Week segment. We're going to start with a quick poll. We always have a poll going on StockCharts TV, and recently we asked you, how important is the presidential cycle in your analytical process? This is obviously a reaction to the special we had earlier in the week. I thought it was really, really helpful. So what did we hear? 45% of you said somewhat important, 31% not very important, 22% very important, only 3% had no idea what the presidential cycle was. So number one, I'm glad that there were only 3% of you, Final Bar Nation, who did not understand what the presidential cycle is. We've at least done our job to a certain degree getting the word out, or you've been able to dig that up on your own. So most of you, I would say, 67%, that's 2 out of 3, would say it's either very important or somewhat important. I would tell you, it doesn't seem important all the time. And when we're in year 2, 2 years after an election, and it's sort of the midterm period for a president, do I think a lot about the presidential cycle? Not so much. When it's an election year, especially a potentially, a very hostile and somewhat contested election potentially, now is the time when I'm paying special attention to. And I think the conversation with those guys on Monday, I wrote an article just recently on StockCharts.com on my blog, The Mindful Investor. If you missed the episode, check that out because I summarized some of the key takeaways. But one of them is, regardless of who wins the election, looking at historical precedent, November and December tend to actually be pretty strong. So between the election day and year end, overall tends to be pretty strong just based on the seasonal tendencies. It doesn't necessarily have to do with the presidential election. So interesting to think about as we review the charts now. So just very quickly looking at what happened today, then we're going to look at the week in review. The S&P finishing a little bit stronger, and really it was a V-shaped day. In the end, we finished a little bit on the more positive side. And I like the fact that after lunch, we sort of rallied into the close, up 1/3%, to 34.65. Mid caps and small caps up a little more. The VIX back down to around 2750. Bond markets did pretty well today, actually appreciated through much of the day. After yesterday's coming off a little bit, we had a focus on the fixed income markets on Thursday's show and talked about some of the general themes there very quickly. But certainly bond prices over the long term seeming heavier from a trend following perspective. Yields a little bit down today. Gold and silver essentially were flat. There wasn't much movement there, but there was movement in energy, with oil down over 2% in the form of the USO, and the energy sector, the worst of the 11, down 0.5%. Everything else was flat to positive, with comm services leading the way. Let's look at the week in review, and then we're going to dig into some of the individual charts. So this is what the week looked like. This is starting the clock on last Friday's close and going to where we at. The big winner obviously was Bitcoin. If you missed that, huge rally earlier this week. We focused on cryptocurrencies. I think it was on Wednesday's show where we talked about Bitcoin and Ethereum and sort of the long-term trends. There's news from PayPal that basically, potentially further legitimizing cryptocurrencies, giving people an opportunity to use Bitcoin in their PayPal accounts. Obviously opens the door for a lot of vendors and sellers that may not accept Bitcoin otherwise to be able to do it. Every one of those little moments sort of provides a boost for Bitcoin. So up 14% this week. The S&P finished down about 0.5%. This isn't quite update for the close. Let's see how we ended up there. But down just a token amount. Looking elsewhere, 3 other assets outperformed. Gold was up 0.2%, small caps up 0.4%. Emerging markets was the best equity performer, up 1.7%. And we looked at that emerging markets versus EFA ratio, which looks at emerging versus developed global markets. And it's certainly been favoring emerging, not just this week, but leading up to this week as well. In terms of what underperformed stocks this week, we had the dollar down 1%, the NASDAQ down 1.3%. Bond prices, and this is the TLT, which we reviewed earlier in the week, down 2%. Crude oil, the worst of them all, down 3%. And so again, we talked about the energy sector and the overall inherent weakness in those charts. Again, I am very hesitant to buy stocks and charts making new lows, and the XLE in general tends to be doing that, which is why it tends to be a mental avoid on my book. Let's go to the Mindful Investor Live chart list. This is where we'll spend the rest of our Wrap the Week segment. As a reminder, if you're not familiar with this, the way to get to it, go to your member dashboard or just go to the articles tab in the upper, on the toolbar on StockCharts. On the right, this, by the way, is that article I mentioned on the presidential cycle, worth reading. But if you click on all StockCharts blogs and go down to the Mindful Investor, you see a link at the top called Live Chart List. This will give you this chart list that we're going to review together here, and you're welcome to save those right to your login. We'll start with the long-term market trend model, and to save time, this has been bullish for a number of weeks, all across the board: long-term, medium-term, short-term. The short-term one turned bullish in mid-late September. This is the bounce off of the lows there after the sell-off from the August-September peak. Since then, it's been positive across the board. The medium-term and long-term models have been bullish for quite a while. The medium-term model turned bullish in May. The long-term model turned bullish in June. And these are based on weekly exponential moving averages, all 3 of them as sort of a general proxy for the overall market trend. This is a model I've run for a long time. And again, this is not, I would never, run money behind this model. This isn't a system necessarily. For me, models aren't an output of the process. It's more of an input. So it's something I like running in the background. I like referring to it regularly just to see what the trend is. This is the first chart I look at every day. And then the idea is after that, you're always reviewing, reflecting back, relating it back to the long-term trend. The trend is positive. So until you start getting, before you start getting super negative, you think about all the downside, remember the trend up until this point has been overwhelmingly positive for stocks in general. Let's zoom in here using the daily chart, looking at the last year. And, this is when I mentioned in the introduction, sort of the range-bound nature of the S&P. We are fluctuating clearly between the 3,200 level, this blue shaded area, and the previous peaks, which is the sort of the 3,600 levels, really just below that in early September. And overall, this is, I think, the range that we're in. We're almost sort of in that midpoint between those two extremes. And so, as a long-term trend follower, one of my guests this week, Jeff Huge, kind of made a point similar to this, which was, at this point, we're sort of there. If you were bullish, that's great. We got to this point. We're now at an equilibrium level where buyers and sellers are essentially in agreement. If you look at the last 3 weeks, we really haven't gone anywhere. We're sort of agreed we're at the right level, which means that at some point we have to resolve this going higher or lower. Either we break above 3,600 or we break below 3,200. Now, I know what you're thinking. You say, well, hold on, what do I do between now and then? And I think it depends on your time frame, right? So as a long-term investor, that's a reasonable expectation that we would remain in this range. And if we would break out, then I have to rethink how you're positioned for more of an extended trend in that direction. And I think that's the way I would certainly be looking at it. A break above 3,600 certainly opens the door to much higher highs. A break below 3,200 could certainly open the door to much lower lows and cause us to retest some of the key levels going back and looking left on the chart there. Again, going down to something like 2,800 is a pretty far cry from where we're at right now, and there are plenty of key support levels between here and there. First things first, you want to watch and see where we're at relative to these key turning points. It's interesting to note, just on a short-term basis, we spent most of the week playing off of this level around 34, call it 34.20, 34.30, which is interesting because that's actually the peak here from early in September. Actually, after we had the sell-off off to the September highs, we came right back up to that price point. This is where we sort of remained right above there. That has ended up being supports. That is kind of an interesting level to pay attention to now going into next week and seeing if that's able to hold. Again, as the market's going higher, you sort of mentally or literally bump your stops up. And that's, I think, a pretty reasonable stop for where we're at given right now, if you sort of buy into this short-term strength story. Let's continue on looking at breadth very quickly. This is our chart looking at the cumulative advanced decline lines. The general idea here is that the mid cap and S&P large cap advanced decline lines have made a new high for the year. The small cap index, the common stock only index, hasn't even broken above its August peak yet. So overall, you sort of have a lack of confirmation. This is not updated for today yet, which we'll see where things tie out. But overall, it's certainly not confirming upside here. And what that tells me is overall the trend has been positive. This speaks to more of the potential for it to go further. For the market to go materially higher, I think you would want to see these breadth indicators all confirming new highs as well, because what that tells you is it's not just a smaller group of names, it's a much broader universe making new highs. Haven't quite seen it yet. Looking at new highs and new lows, by the way, I think there is a definite change from early October where you saw a steady increase in new highs, peaking out around 16-17% of the S&P making a new 52-week high that second week in October, to now we've sort of stabilized. It's consistently around 5%. So basically 5% of the S&P making a new high every day, everything else not there yet. And so, for me to feel better about upside for stocks, I would want to see that increasing. I feel better when that's going up because that tells you it's more and more stocks able to eclipse their highs from earlier this year. Not seen it yet. If and when we would sell off, this is the chart I'd refer to a lot more, which is the percent of stocks above key moving averages. This one here, the first panel below the price, is the percent of stocks above their 200-day. You can see in both phases, it tends to remain above 50%, as it did here going into the September low. In more extended bearish phases, you'll see it break below 50% and remain there, which means if and when we would go lower than here, if we would start to get down to that 3,200 level, this is one thing I would look at just to sort of qualify what we're seeing with the price itself and see if there's enough downside momentum of stocks breaking down through their 200. The S&P is obviously pretty far away from its own 200-day, and many stocks are as well. So the chance of that happening soon is pretty low. The AAII bull-bear spread, we talked about this on yesterday's show, so I don't want to beat it down too much, but only to say this turned net positive for the first time since February. Overall, it's been leaning more bears than bulls in this survey of individual investors. The bullish percentage, as Mark Young was pointing out yesterday, is not quite at the level. Above 40%, maybe a little further, is where you start to line up with overextended periods going back. That's what we saw in January of 2020. That's what we saw here in April to May of 2019. We're not at those levels yet, which tells you you're still sort of in that middle of the road level of bullishness. It's not there yet. This chart's a really interesting one. It's starting to get into some of the ratio analysis that we do. This is where we'll finish off our wrap the week segment. This is the equal weighted ratio of consumer discretionary versus consumer staples. One of my mentors and predecessors at Fidelity, this guy Bill Doan, who ran the group in the 70s and 80s, had a chart of offense versus defense that he had in our chart room there. And the indexes he had used were gone. They weren't in the market. They weren't out anymore. And so we adapted it to this, looking at consumer discretionary versus consumer staples. What's happened with the regular ratio of the two is Amazon's such a big weight in the XLY. Now, overall, the ratio is breaking out, so that's working. But the equal weighted ratio tells you a little bit more about how institutions, I think, are rotating between those bets. Are they allocating more into consumer discretionary, consumer staples? This equal weighted measure of those two is clearly favoring consumer discretionary and breaking out. So in a measure of offense versus defense in equities, you're seeing it still favor offense. One thing that is just coming off a little bit in the last couple of days is the relative performance of semiconductors. I would remind you, there's a reason why we're looking at the last year before we get too excited thinking about the end of the trend and the trend rolling over. This is within the context of a pretty incredible run of relative strength for the semiconductor group. This is using the SMH, which is a liquid semiconductor ETF. So overall, I think it's too early to identify that this is any sort of weakness, but certainly short-term pulling off a little bit after an incredible run of relative performance. That group remaining strong on a price basis and on a relative basis, certainly core to, I think, it's a great measure of the overall strength of the economy because so much is driven by the strength in semiconductors. We only have time for the one last chart. Looked at small versus large yesterday. I think this is one of our 3 and 3 charts. Just want to point out that it's back above its 200-day moving average for the first time in a couple years. This is really favoring small caps. So if you haven't been looking down the cap tiers a little bit at the mid cap and small cap space, I hope this chart reminds you that small caps are actually in the pretty strong relative position. Now might be a really good time to think about some opportunities down there. We're going to take a quick commercial break, back with the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. We love to hear from you. We've received so many great questions in the last couple of weeks. Really appreciate what you're running into and love to help you any way we can. Shoot us an email, thefinalbar@StockCharts.com, with any questions you run into in your normal analytical process, and we'll get to as many as we can. Let's get to the final bar mailbag now. Our first question: I'm a portfolio manager and my portfolio's performance is judged relative to the S&P 500. I have a philosophical question. Are supports, resistances, and trend lines as important in price relative charts as in simple price charts? What about the use of indicators such as RSI or moving averages? Do these work in price relative charts as well as they do in price charts? So I really appreciate that question. You probably hopefully know from when I've mentioned it, much of my career, part of my career certainly was spent at Fidelity Investments working with professional money managers. And in my career before that at Bloomberg, I spent a lot of time with money managers and institutional participants. And so the idea of relative performance is key. And there's a reason why any stock chart I show you, 99% of them have the relative strength line at the bottom. And I have found institutions just take that for granted. We obviously want to look at the relative strength line because that's how we're evaluated, is your ability to outperform the S&P. So you want to own stocks where this line is going up. And if you own stocks where the line is going down, you're hurting your performance. You have to address that. I found a lot of individual investors don't pay as much attention or enough attention, and that's why I try to reiterate the benefits of it as much as I can. Your question particularly is, do you apply support and resistance, things like that, directly to the relative line? And I'm going to break your question in two because I think my answers are going to be different. Do I look at price patterns? Do I look at support and resistance levels and trend lines? So the answer is kind of, and I'm sorry I can't be more specific, but I think to a degree, I think with stocks with actual price charts, support and resistance levels are meaningful because the market has memory, right? The idea anecdotally is that buyers or sellers came in at a certain level, that level has meaning to them. And so people are going to react to their anchor point, a price point on a particular chart. This is why support and resistance levels work so often. And when a stock rallies into a resistance range, you find a lot of times it comes up because people look left on the chart and they use those levels, they key in on those levels. With relative strength, I don't use them as support and resistance, but I certainly use the levels to pay attention to new highs and new lows. So one of the common screens I'll do is stocks making new 3-month relative highs, 3-month relative lows, 3-month price highs, 3-month price lows. And that's basically looking for when the relative strength line, I guess you could phrase it as breaking above resistance, right? Breaking to a new high. But I don't think of it as support and resistance. I think more of a new relative highs, new relative lows. That's how I usually would phrase it. Your other part of your question was dealing more with moving averages, running indicators in RSI. I don't use that on the show. I don't show it very often. I've worked with a lot of institutional technical analysts that do very well, running things that way. The person who comes to mind, Nick Glyden from Redburn Partners. He's based in the UK, in Europe. I forget where he's located at this point. Based in London/France, and his work was always very based on relative strength. Did a really good job of analyzing them. I know we've spent a lot of time doing that as well. So yes, it's certainly possible, and to be honest, preferable. If your goal is to analyze a relative line, I would look at charts just of the relative line and then run indicators on the relative charts. That's a really good place to go. Question number 2, here's a chart of Navient, N-A-V-I, and I'm bringing up your chart. Thanks so much for sending the link. I notice it's about to have a crossover of the 50-day moving average and the 200-day moving average, which is sort of here, the blue crossing the red line. I think this is a bullish sign, but I noticed the MACD indicator appears to be topping and rolling over. How do you sort of reconcile that is how I'd summarize your question. So the 50-day crossing the 200-day moving average is something that I think the financial media loves to highlight because it has a really cool name, Golden Cross, and the downtrend has a name, the Death Cross. Let's look here at Dead Cross. Here's the problem. It is a very, very lagging indicator. So the sell signal that you got here when these two cross was right about here. So that means, yes, you got a little bit downside, but only about a day or two before the stock actually bottomed out. So it's not like it tells you when things are actually turning. It tells you way after the fact. So these moving averages crossing here sort of recognize the fact that it's been in a trend for 6 months. And so I don't know if that's necessarily a great timing signal. What I do look at is the price above the 50 and 200-day moving averages, because that tells you a little bit about the short-term momentum versus that long-term trend. If you're trying to understand the trend of the stock, I think using the MACD or the PPO as you're doing here is a much better read. And looking at it on the daily chart, as you can see, sort of gives you this these swings going up and down, and you've highlighted some of the price points. So I think if that is your game and you're trying to do the short-term swings, the daily PPO is going to be much better for that than something like the 50 and 200-day moving averages. There are shorter moving averages combinations like the 5 and 20-day come to mind as maybe something you might want to look at. Next question. I know candle charts are amazing, but I can't envision what they mean. The stock closed at this, did this, empty, filled candle, red or black candle, but up. Is there any way to let us see what information is encoded in a candle? Yeah, I'll do my best here. So let's do this. We're going to stay on the same chart. We're going to look at 1 month. Perfect. There we go. And then we're going to start here. So, right here, we're looking at this candle on October 21st. We open here. That's the tick to the left. We close here, the tick to the right. The vertical line tells you the high and the low. So all the candle chart is telling you that same information. It's just doing it in a different visual way, because if you look very quickly, it's hard to see which days are up days and down days because the bars all kind of blend together. Spending time with analysts and traders from Japan, it sort of illuminated these charts because you can see the big uptrend and then the big black candles, which are down days, right? So a solid candle means you open at the top of this body, you close at the bottom, just like the tick to the left and the tick to the right. It's just filling all that in. An open candle, you tick to the left, tick to the right, it's a big up candle. The way I remind people when they're just learning is a solid candle, think of it as something solid, it's heavy, it's a rock sinking down in a pool, so it opened at the top of this body and it closed down at the bottom. If it's something clear, it's hollow, it's a balloon, it's filled with air, and it's floating up, so you opened at the bottom of the candle, you floated up and closed at the top. Where it's helpful is just visually seeing a trend of up days or a trend of down days. It literally jumps off the page at you. And I've spent time with Japanese analysts and traders just using candles, and that's it. And it convinced me of the value of the visualization. Just for simplicity, I don't show them a ton on the show, but I definitely, if I'm a short-term trader, I would be using them heavily. We'll get through a couple more questions here. Thanks for showing the Bitcoin chart analysis. Looks like a giant reverse head and shoulders. Let's look at the chart we were reviewing earlier in the week. Where is it? Here we go, Bitcoin. So, this is the chart we looked at, which is this, and I think what you're getting at is this a huge inverse head and shoulders, right? Which is this low surrounded by higher lows on both sides. And yes, I think you would technically probably have to call this some sort of complex head and shoulders. It's like a head and shoulder and a head and shoulder and shoulder. So you technically call that a little different. This isn't the most idealized version of that just because the trend wasn't huge leading up to that. But overall, I'm thinking of it more in terms of support and resistance levels and less as a huge head and shoulders. What you're implying is that you can measure this neckline, for example, project that all the way here, which puts Bitcoin at like 25,000 or something like that. Listen, that's certainly possible. I wouldn't say that's not going to happen. But again, we have a long way to go before then. I'm paying much more attention to the support and resistance now that we've broken above resistance from a couple months ago. I think that's a clear support level coming off. Below there, 10,000 is really the ultimate line in the sand. I would expect us to remain above there. Next chart, I saw your tweet today talking about the bearish divergence for the XLY. As I look at low, I'm not sure I see the negativity in the chart you're referring to. Here's my chart setup. Any thoughts? So it's number one, beautiful chart. This reminds me of sort of Grayson Rose's charts or Tom Bowley's. So you are following some master stock charts users. If this is what you're looking at, these are really well done, and you're incorporating a lot of information here, a lot of relative lines, which I think is fantastic. So, yes, when I was talking about lows and the XLY and potential topping patterns, it was based on a bearish divergence using RSI. Everything you're looking at, glancing down the list, is more in the trend following bucket, meaning it's going to tell you strength versus weakness, sort of everything below the price down here. Above the price, you have RSI, and that's where you see the lower peak in RSI from the late August peak to where we're at right now. So this is sort of your leading indicator telling you when the price is potentially exhausted. These are all lagging indicators, which are very valuable, but it's all telling you the trend has been positive. So this is what a stock would look like before it tops out, is all of these are thumbs up, and then you get the bearish divergence, which tells you the trend may be exhausted. Then if it does actually start to turn down, what you should be looking for is when these would start to revert lower and give you more of a sell signal. We haven't seen that yet, and that's what I was sort of implying. Hopefully with the limited characters in a Twitter and in a tweet, hopefully I was getting this across, which is the lagging indicators are positive on consumer discretionary. It's the leading indicators, it's the exhaustion signals, which may be telling you that we're at sort of a topping point. So that's how I would reconcile those things that I said with your chart there. Those are really thoughtful questions. Again, those are all coming from you guys over the last 48 hours or so. Please keep them coming. We'll get to as many as we can. We need to wrap the show, though, and go to the 3 and 3 charts. 3 minutes. Here we go. Chart number one is consumer discretionary versus consumer staples. We talked about this a lot earlier, but I just want to point out on an equal weighted basis, which takes the overweight of Amazon out of the picture, this ratio is still going positive, which tells you from this one measure of offense versus defense, investors are betting more on offense, and that reflects, I think, institutional positioning for sure. Two other charts to sort of leave you with. One is there are charts like this. I was asked about lows. I talked about the XLY. Here's another stock in that same sector, McDonald's MCD. You see the higher highs in price, the lower peaks in RSI. So, and the relative strength is sort of flatline. So this is kind of what things feel like right now. The trend has been positive. That's absolutely great. If you have money in a name like this, I don't see anything on the chart yet telling you that there's any sort of breakdown. The trend continues to be positive, higher highs and higher lows, but I'm getting a bearish divergence, which for me is not a reason to sell. It's a reason to put it on your list of charts to watch for potential breakdown. On something like McDonald's, 225 is the real short-term breakdown, but really the 50-day and then the low around 214, call it 213, which would be the lows from late September. That's what a rotation you would want to see that would validate this bearish divergence and suggest further downside. We haven't seen it yet, though. While we're doing that, though, again, I'm always reminded of charts in downtrends. Lower highs, lower lows is a downtrend. So regardless of what you think of Cisco, the company, Cisco, the stock, is in a downtrend. Now, in the short-term time frame, it's now broken above and made a bit of a swing. I'd like to see it get above 41, above the 50-day to rotate and sort of complete this bullish rotation, which would also give it a higher low. We haven't seen it yet. The relative strength still has been very weak. So I think overall, if you have to be somewhere, I'd much rather be in stocks going up than in stocks going down. Folks, that is our show for today, and that is a wrap for this week on the Final Bar. I want to thank you so much for joining us every weekday. Please get your questions to us via email, on Twitter, or on our YouTube channel. For StockCharts.com and Redmond, Washington, I'm Dave Keller. Be safe Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.